The news anchors were losing their absolute minds. Elon Musk, world's first trillionaire, rockets, Mars, humanity's future, peak civilization. You've seen every version of this headline in the last 2 weeks, plastered across every financial channel, every business subreddit, every push notification you reluctantly let through. And honestly, watching mainstream financial media trip over each other to celebrate a single human being crossing $1 trillion net worth is, it's kind of impressive in the most exhausting way imaginable. But here's what nobody led with: that 1.14 trillion in personal wealth, which, just to give you a sense of scale, is roughly enough to buy every Netflix subscription on Earth for the next 47 consecutive years, did not materialize out of rocket exhaust. It did not fall from the sky. It came out of your brokerage account, your index fund, your 401k. The retirement savings that you technically own, but that Wall Street quietly controls. And once you see the actual plumbing underneath this thing, you genuinely cannot unsee it. On June 12, 2026, SpaceX went public. Ticker SPCX. The offering price was $135 per share. It opened at $135, an immediate 11% pop, and then closed its debut week at $160.95. Robinhood was on fire. Fidelity customer service crashed twice. The narrative being pushed to retail investors everywhere was clean, simple, and intoxicating. You were buying into a pristine 2.1 trillion mega cap space company, backed by the world's most unstoppable satellite internet business. The future on sale right now. And if that were the whole story, truly, genuinely, maybe it'd be fine. But that is very much not the whole story, because tucked inside the belly of this rocket is a smoking, bleeding, catastrophically negative artificial intelligence company that had completely run out of road. Private investors had stopped writing checks. The venture capital runway was gone, and the only available solution was to quietly launder the entire mess through the most hyped public offering in the history of financial markets and sell it to you at a multi-trillion-dollar markup. This is the biggest bait and switch Wall Street has ever executed, and the audacity of it is almost worth admiring. Almost. All right, let's pull this apart properly. I want to break this down into what I call the 3-layer stack: the good, the bad, and the ugly, because the really dangerous traps, the ones that actually cost regular people real money, are always the ones with something genuinely, legitimately attractive on the surface. The good. Starlink is, and I want to be accurate here, actually a phenomenal business. In 2025, it generated $11 billion in revenue from satellite internet subscriptions, and that number is compounding. You've got remote farms in Montana, fishing fleets in the South Pacific, active military operations in conflict zones, all running data through the same constellation of low-orbit satellites. It is sticky, subscription-based, geographically monopolistic revenue that grows with every single launch. And the rocket launch business itself, SpaceX has captured roughly 60% of the global commercial launch market. The competition is not close. This is not a company that stumbled into dominance. They genuinely earned it. So when Wall Street hands you the SPCX pitch deck, this is what you're looking at up front. And it looks extraordinary. It looks like the future being packaged for public consumption, which is, of course, precisely the point. The bad. In February 2026, very quietly, with about as much public announcement as a minor SEC filing dropped on a Friday afternoon, SpaceX executed a full all-stock merger that absorbed 2 entirely separate Musk entities: xAI, his artificial intelligence venture, and X, the social media platform you probably still call Twitter when no one's listening. The combined valuation assigned to these 2 assets at the moment of absorption was $125 trillion. I need you to actually sit with that number, $125 trillion, for a social media platform that has been hemorrhaging advertisers for 3 years and an AI company with no commercial product generating meaningful revenue at scale. That figure is larger than the entire GDP of Mexico. I'm not editorializing, I'm just reading the filing. And now, here's where the corporate disclosures get genuinely, almost impressively dark. While Starlink was printing $11 billion in clean subscription revenue, xAI was incinerating capital at a pace that would make a blackjack high roller blush. The XAI unit posted a $635 billion operating loss in 2025, driven almost entirely by the electricity and infrastructure costs of running the Colossus supercomputer cluster around the clock. The knock-on effect on SpaceX as a whole? The company flipped from a $791 million net profit, a genuinely healthy, growing business, to a $494 billion net loss in a single year. Reversed. Negative. Here's an analogy that makes this click instantly. Imagine you run a really successful coffee shop. You're clearing close to $1 million a year. Margins are strong. Regulars love you. The business is compounding. Then your brother-in-law convinces you to acquire his startup, which turns out to be a warehouse full of overclocked computers that run 24 hours a day and produce absolutely nothing. Your electricity bill now exceeds your entire revenue. You went from profitable to deeply negative without changing a single thing about the core business. That is not a metaphor I'm stretching for effect. That is a functionally accurate description of what happened to SpaceX's financials between 2024 and 2025. The ugly. So why the IPO? Why now? And why this structure? Here's what the financial press is not saying plainly. Private venture capital had completely and entirely dried up for XAI. No institutional investor with fiduciary obligations to their LPs was going to write another billion-dollar check to fund orbital supercomputers when the existing Earth-based ones were already torching the balance sheet. The private funding mechanism was finished. And so a decision was made, and look, if you're wondering how it is legally permissible to stuff a $635 billion money-losing AI operation inside a legitimately profitable space company, assign the combined entity a $2.1 trillion valuation on less than $20 billion in actual total revenue, and then sell it to retail investors on Robinhood. The honest answer is, I have absolutely no idea how that is allowed, but it happened, and here we are. The official stated purpose of the IPO was capital formation to accelerate humanity's transition to a multi-planetary civilization, which is lovely, genuinely lovely. Translated out of corporate speak, what they actually mean is XAI's balance sheet was on life support. Private money had stopped arriving, and the only remaining mechanism to raise $75 billion fast enough to keep the Colossus servers running was to take the whole thing public and let passive retail capital absorb the bill. Here's the analogy that makes the S-scale of this clear. Imagine your local utility company secretly overloading your entire neighborhood's power grid to run an underground data center in the basement of a shopping mall. Instead of fixing your blown transformers, they call a press conference and announce they're building a $1 trillion extension cord directly to the moon. And by the way, you're funding it via a mandatory crowdfunding campaign embedded in your pension plan, while your kitchen lights are actively flickering. That is the cosmic extension cord. And the second SPCX entered your index fund, you got plugged in, whether you wanted to be or not. Now, let's talk about the precise mechanical sequence of what happens next, because this is where it stops being abstract and starts being personal. The moment SPCX debuted at a 2.1 trillion market cap, it instantly became the 6th largest publicly traded company in the United States. That single fact triggers something that most retail investors have never thought about and almost never discuss. Automatic, non-discretionary buying mandates from passive index funds, your S&P 500 ETF, your total market fund, the target date retirement account your HR department auto-enrolled you into that you haven't logged into since the last market crash. All of these vehicles are legally required to hold every major publicly traded company in proportion to its market cap. The fund managers do not get a vote. They cannot say, wait, this entity lost $5 billion last year, and the core new asset is a supercomputer whose electricity bill exceeds its revenue. The mandate says buy. So they buy, and while all of that non-discretionary buying pressure from passive retail vehicles props up the share price, creating the appearance of organic, enthusiastic market demand, the original venture capital investors who have been sitting on illiquid, unmarketable private shares of XAI and X for years are executing their exit in real time. They have successfully converted private frozen equity into liquid, publicly traded SPCX shares, which they can now sell freely into the open market. Translated out of corporate speak, what that actually means is this: the early insiders needed a way out. The IPO was the exit, and passive index funds full of ordinary people's retirement savings are the liquidity pool they are exiting into. You are the buyer of last resort, and you were never asked. Now, Elon Musk has been publicly candid about the long-term rationale. He has openly stated that Earth-based energy infrastructure simply cannot sustain the demands of next generation AI without causing public electricity shortages. The proposed solution, and again, this is stated openly in filings and on-record comments, is to construct orbital AI data centers powered by space-based solar arrays, which, look, as a piece of science fiction, it's genuinely thrilling. As a business plan being funded by your retirement account in Q3 2026, while the company is losing $5 billion a year, it's a different conversation entirely. And when Q3 earnings arrive and the XAI cash burn appears in full on a public income statement for the first time, no more private obscurity, no more selective disclosure, that number will hit the market like a freight train. Because the math between the 2.1 trillion valuation and the sub 20 billion revenue base does not survive contact with quarterly reality. Let me map this to your actual life. 3 pressure points right now. First, your investment portfolio. If you hold any broad tech exposure, any major tech ETF, any mega cap index, the violent repricing that follows XAI's first public earnings report will ripple through the entire sector. Margin compression at the top drags everything correlated downward. It has happened before. It will happen again. Second, your electricity bill. This is the one almost no mainstream outlet is connecting for you. AI data centers are actively outbidding local municipalities for grid capacity. Utility providers are not absorbing that incremental cost out of goodwill. They are passing it directly to residential consumers through rate hikes that have nothing to do with how much power you personally consumed. The AI energy crisis is already inside your home. It's just hiding inside your monthly statement, disguised as routine rate adjustments. Third, your retirement account. Because passive target date funds and default 401k allocations are structurally required to match market cap weights, millions of working class savers will be automatically allocated into SPCX at or near its speculative peak, swapping stable, diversified purchasing power for a volatile, cash-burning, sci-fi infrastructure bet that they never consciously chose. Here's the thing about passive investing that almost no one says out loud. It is the most powerful long-term wealth-building mechanism ever designed for ordinary people, right up until the moment institutional actors figure out exactly how to weaponize its mandatory inflows. And when a $2.1 trillion company with a $4.194 billion operating loss gets dropped into your index fund by sheer market cap weight, you don't get a warning. You don't get a prospectus. You don't get a vote. The money just moves quietly, and you find out at the next quarterly statement. That is the trapdoor, and it was engineered with absolute deliberate precision. If this is the kind of thing you want, the actual mechanics behind the headlines, the structural realities that the financial news channels will never explain, because explaining them is not in anyone's institutional interest. Subscribe. Hit the bell if you actually want these in your feed and not buried by the algorithm. No hype, no rocket smoke, just the real plumbing of where your money is going. See you next week.